Hello and welcome to Leaders in Lending, brought to you by Upstart. I'm your host, Barry Roach, and I'm happy to be joined today by Adam Brice, the Chief Lending Officer at EFCU Financial in Baton Rouge, Louisiana. Now, Adam's first visit to the podcast was in late 2022, and he talked about advances in underwriting technologies and how that fits with a common sense approach to lending. In today's episode, Adam's sharing his views on today's auto lending environment and how credit unions can adapt to capture market share. Adam also talks about how credit unions play a big part in supporting their community and shares how EFCU Financial has teamed up with local universities to help students improve their financial literacy. Thank you for listening. Let's get started.
I'm doing good, Barry. I'm happy to be on the podcast, and I'm looking forward to going through some different questions with you. How are you today?
I'm good, thanks. Thanks for joining us. So, Adam, you were on the pod in December of 2022. What's changed between now and then? I mean, probably a lot of things on the lending side. But you had talked back then around some shifts in indirect auto lending. And if you think about it, that time period, we were still kind of coming out of the pandemic and some of the supply chain issues that had been happening back then. And that was certainly impacting auto lending and credit unions and other financial services. What shifts have you seen really in indirect auto lending since that time period, going back 2.5 years or so?
There has been a couple shifts, and I had made a prediction kind of during and after COVID that I thought the days of full car lots and plenty of inventory in the lots, I thought those days were done, because you saw the way that dealerships were handling business during the COVID times. Some dealerships only had 5, 6, 7, 8, 9 units on a lot, and they were having record profits, record months. And when you have a bunch of inventory sitting on the lot, I mean, as you know, that's just interest running, and that's just a lot of expenses there that's just sitting on the lot. Nothing's really happening to those expenses. But now, as we fast forward to 2025 and I kind of look around our area, dealerships are full back up of inventory. There's plenty of inventory just about at every dealership that I see. So that shift that I thought we were going to see of, units and inventory being a little bit less, it's kind of not happened, and it's come back to seeing full lots, full inventory. And then, you're seeing some captives kind of move away from indirect lending. You've seen some kind of re-enter the market. And I think, especially here in our area in Louisiana, insurance is always going to be a big factor, because we are in a natural disaster prone area like Baton Rouge, Louisiana, and Southern Louisiana in general. Insurance is always going to be, a big issue. And that's been a big issue for some of our members, being able to obtain insurance, whether it be auto or home, just because of some of the natural disasters that we've seen in this area over the past 8 to 10 years.
Right. So really, I guess to summarize, a lot of the supply chain issues have seemed to have abated. We're back to seeing some lots that are full again. What else do you attribute that to, though? Because, I mean, let's face it, cars are lasting a lot longer now than they were maybe when you and I started driving, right? The average life of a car with a carburetor, for example, didn't seem to last all that long. And nowadays they're just manufactured in such a way that that they just last a little longer. I mean, are you seeing that on the used car side, that's having an impact on sort of valuations for in your underwriting processes, or changes in maybe some of the consumer behaviors around that?
I think we're seeing some change in the consumer behavior. I think people are holding on to their vehicles a little bit longer. Valuations have certainly increased, especially during COVID and moving on through the years now in 2025. But you kind of can look around, and people are holding on to their vehicles a little longer. Even, our portfolio in general, we see people kind of holding on to vehicles just a little bit longer than they typically have. And it's resulted in, people using their vehicles a little bit more. They're running them a little bit harder. And then when they get to the time where they do get to trade, typically, they've put a little bit more miles on the vehicles that we've seen, and we've seen, negative equity climbing a little bit. And I think that's kind of a two-pronged answer there, because I think with some of the valuations that we've seen, during COVID and kind of after COVID, the valuations are extremely high, and I think you've seen some of that level out. over the past couple of years now. So when people were buying, 2 and 3 years ago, and now they're coming to that, 36, 38 month time frame where we're seeing the standard, member come in to trade a vehicle in, their equity is a little bit more negative than they're maybe accustomed to, because of the valuations at that time that we were seeing, a few years back.
Sure. Yeah, I remember in 21 and 22, I was working at a credit union at the time, and we're looking at valuations that were coming in because used car values just shot through the roof, and thinking, well, that's great. What's the residual value going to be if I have to collect on this thing in 2 or 3 years? And from talking to collections professionals across our industry, they're kind of seeing that happening right now. That, as you said, a lot of negative equity, and if someone does have some sort of financial misfortune that makes them not able to make those payments anymore, not a lot of value left after repo. Have you experienced something similar to that down in your region?
Yeah, we have, and I think that's something else to be talked about is the longer terms. Now here, especially in the Baton Rouge area, an 84-month term is fairly standard. That represents probably over half of our monthly indirect business is in the 84-month term. So with the higher valuations, the higher terms, that negative equity is kind of getting pushed a little bit further and further. And when people do come into trade, not only are they a little more upside down because the valuation may be a little bit higher when they purchased in 21, 2022, but then maybe they signed on for an 84-month term. So really you're into the 48 to 60-month area of that term of the loan. You've not paid as much principal as you may have originally paid, in prior loans, because let's be honest, 72-month was kind of that standard loan term now. And then now the 84-month term is just so much standard, especially for us and in our area. It's what drives a lot of volume in our market. And a lot of that I think can be attributed to vehicle prices have gotten a lot more higher and a lot more expensive. Um, People are still trying to keep up with the Joneses, and trying to, they're shopping more payment conscious versus maybe what's more practical for them. And so, well, we can get a lower payment if we stretch out the term to say 84 months. And that's what we're seeing a little bit of now. And I think people are ultimately starting to pay the price for it, as they're coming due, whether they're trading the vehicle in or if they're struggling to make their payments. And what happens is the negative equity is so high that when a vehicle does get turned in for a repo, or it gets, there's a wreck or something, an accident, the vehicle gets totaled, the value is just not there. I can share my own personal story. My wife and I bought a vehicle in October of 2021, right when the vehicle value craze was really kind of getting a little wild. The clean trade on that vehicle was 43,000. In January of the following year, which is about 4 months later, I pulled the value on her vehicle, and the vehicle had jumped up in value to $51,000. I have never in my life, and I've been in lending now over 15 years, I've never in my life seen a car appreciate in value the way like that did, much less cars genuinely appreciating, period. But for it to appreciate almost 25% was just astronomical in my opinion. And that's just a one sample, that's a one-off deal of one vehicle. It was like that for thousands of vehicles and thousands of members who are feeling that effect. And now, a year and a half later after that, the value had significantly dropped. And I think that's what you're seeing now with the negative equity and the people trying to trade in with longer terms now.
Sure. I mean, think of this low rate environment, Adam, that we enjoyed in the auto lending space. I shouldn't say we, as lenders, it was tough for us, but as purchasers, as borrowers, it was great. There were 299 auto loans pretty much available for, like a 6 or 7 year period like that, right? So that was, you talk about when values were up at the end of 21 into 22, that was kind of the end of that era, if you think about it, because inflation started and then interest rates started to pop up. So those 299 auto loan deals now are 699. And can I afford that $50,000 car in a 72-month term? Probably not anymore. That's why it's getting stretched out to 84. And then you have the add-on products, right? So there's some sort of if there's gap or some sort of other sort of mechanical breakdown insurance or something like that. So has that meant that EFCU has had to sort of change aspects of your underwriting policies or the way that you're looking at the asset? Or are you sort of weighing the asset versus the borrower quality any differently now than you would have been, say, 2-3 years ago?
I'll be honest with you. We weigh it kind of the same as we did 2 or 3 years ago. It's just kind of a natural progression that collateral and inventory has taken, and we've kind of just naturally kind of gone with it. One of the things that I preach to our underwriting teams is consistency. What we approve today is what we will approve tomorrow, and what we will approve next week. Um, in order for us to be and for us to stay consistent and to be so successful that we are in indirect lending, it helps the dealers understand that they know, hey, EFCU is going to buy this deal, next week or today or tomorrow, and that's helped really a lot with our progression in direct lending, our protection in consumer lending is just staying consistent across the board, and always doing what's right, what's in the best interest of the member, and what's just in the best interest of the credit union. If the loan makes sense, I can promise you we're going to do it regardless one way or another. If it makes sense, we will do the loan. And we've seen that kind of consistency play out, from time and time and again with our portfolio. Our loan portfolio has been outstanding. We have some of the lowest delinquency in the state of Louisiana. Our charge-off numbers are some of the lowest charge-off numbers in the state of Louisiana. And I really preach that to the consistency and to the underwriting soundness and reviews that we consistently do day in and day out.
Right. Now, you use a common sense approach with that, Adam. I remember from your last pod, you talked about that certainly you've got your underwriting policy, your general lending policies, specific policies for auto loans, and then you use technology for the underwriting process. So you're not just relying on just sort of a credit score, or, there's multiple aspects of the credits, the borrower's credit worthiness that you're looking at. So has that had to change any at all in these past few years, or is common sense still very much a critical component of your underwriting process as you're looking at each borrower that comes through your system?
Common sense lending is still the number one priority here at EFCU Financial when we're doing loans. At the end of the day, and I tell my underwriters this, if you can answer this question, and that question is, will this loan be repaid as agreed? And if you can answer that question, and you can answer yes to it, then we should be doing that loan. Because at the end of the day, regardless of what the loan is for, if you know that the loan is going to be repaid back, and you can say yes to that question, then you should be doing that loan. You should be figuring out a way how to do that loan, whether making an exception to a policy or a procedure. Because at the end of the day, it's all about the borrower's repayment ability, and if they have the ability to repay, and you can answer yes to say they're going to repay this loan, then you should be able to do the loan. And that's kind of the typical practice that we take here at the credit union at EFCU Financial, and that's how we've kind of always kind of worked in that way for the past 10 to 12 years. And I will say that it seems like a very good approach for us. But to say that is always going to be the same way. No, because we're going to be looking at some type of AI, software here in the future. We may be looking at Zest or Synaptics, or maybe some other type of AI vendor to kind of, move forward with our lending, and move into some more automation, some efficiencies, driving automatic decisions.
Right, right. And which is, I think, a smart way of doing it. You can still retain that common sense judgment, which is necessary. But the ability to have consistency with common sense lending, you and I both know, like people are going to have a different perspective, as they may look at a loan application. You may look at it differently than I would, than someone else would. And I think that's where maybe AI comes in to assist with putting some guardrails around what that underwriting criteria would be. And I know that EFCU is also looking at other ways to sort of gain more consistency around that lending decision. So maybe you can sort of share with our audience a little bit about how you've changed how you're looking at lending in branches, and now you have more of a centralized aspect of that. So maybe take us through that a little if you could.
Yeah, absolutely. So last year, in the middle of the year, we had decided that we wanted to create a loan contact center. And basically, some of the things that we were seeing in the branches were, we had 45 to 50 different loan officers in the branches. Some of them wanted to do loans. Some would rather just be a teller and work a box. Some of them would rather be a head teller, and other ones wanted to work different duties. And we kind of recognized this, and we could see it in our lending numbers. We could see it in our debt protection numbers and our ancillary product numbers with the gap in warranty. You can kind of see certain people who would really, really relish in that fact that they got to, cross sell on loans and really succeed in some of those things. But then we had others who were a little bit inconsistent. Their volume wasn't being driven as high by motivation. They would rather do some different things. So what we decided to do as a credit union was create a loan contact center. So what we did was we put out, some job descriptions for, we wanted to bring in 5 to 7 of the best loan officers that we had in the branches, centralize them here at our operations center, where they would just focus on loans and branch loans all day, every day. We've created a kiosk, kind of a kiosk center in each branch, where we have a computer station there where a member can do, they can do live in video with one of the loan contact center reps here at our operations center. They can also do remote video from a cell phone. So if they're at their house and they want to have a video conference with one of our loan contact center reps, they can easily log on and have a video chat from their house with one of our contact center reps. And basically what this is doing is we're filtering all of our consumer lending origination into 6 different people and 6 representatives, 6 of our loan experts. So instead of training 40 to 50 different people, we're training 6 to 8 people, and it's just loans all day, every day. That's all they do. We're training. They get training, heavy training on ancillary products, debt protection, cross-selling, identifying opportunities on credit reports, to make cross-sells. And this has been, one of the things that we were really targeting, because we really wanted to see our consumer lending numbers really get a good boost. We wanted to see some of our net interest margin get a boost. And we were struggling with some of those things like debt protection, ancillary products. And this was kind of our answer to that, was to be able to filter in, all of our consumer loans from the branches into 6 different people who are working loans all day, every day. They're not working on a box. They're not opening up an IRA in the branch. They're not dealing with fraud issues from different members coming in, and having issues like that. It's all loans all day, every day. And, when it really gets together and it really starts hitting on all cylinders, we really believe that we'll have one of the top options for consumer lending in the state of Louisiana.
Hitting on all cylinders, I get that, right? The little pun there. So all gas and no brakes, to use another pun, right? Really, this is a dedicated sales force that all they have to do is go out and with these new borrowers, not just create that new loan solution for them, but also look at those ancillary products. So I would imagine you've seen some cross-sell opportunities or some cross-sell successes that have come from that approach as well.
Absolutely. I mean, our debt production numbers have steadily started climbing. You're seeing our ancillary products, start to climb with gaps and warranties, which means our net interest margin, our non-interest income is starting to take a boost. And that's exactly where we want to be and we want to see. And we want to continue to get those numbers better. And as that contact center develops and grows and matures and seasons, as those people get stronger and stronger with loans, we expect, those numbers just continue to escalate and get higher and improve, all of those things that we're talking about, whether it be net interest income or non-interest income, and our net interest margin continue to improve and grow.
Yeah, I mean, improved net interest margin, music to ears for every CFO out there. It's so hard right now, especially when we've had what 3 rate cuts since September of 2024 that have not taken hold in the interest rate market at all. We're still seeing the 10-year, for example, in around the 440s at the time of this recording, and there's so much uncertainty out there as to where the interest rate environment will be going. Has that had an impact for EFCU in terms of your planning for 2025? There has been margin compression because of the cost for the credit union to get a dollar to come in, and then there's pressures to decrease interest rates so you can be competitive in your marketplace. So with that margin compression, has that shifted or has that changed in any way your growth prospects for 2025?
Yeah, I mean, we've always been a heavy certificate of deposit shop, where that's how a lot of our deposits were coming in, and we've made a shift, to try to move away from that, to try to get some non-maturity deposits in the door. We've made some changes to our money market product. We've made a couple of changes to some of our checking account products to try to bring in some of that non-maturity money to come in. So, we're not, we're sitting on fixed costs, for CDs, where our average, certificate rate probably in 2024, I want to say was around 4.5%. And then when you have rates, kind of in the 6s, 6.5, 7% area, that margin is not very big. That's a very thin margin, especially when you talk about you factor in cost, labor, software, delinquency, charge-offs. I mean, that's a very razor thin margin that we've seen. So we've shifted our focus, from being, a heavy CD shop to more of a, try to bring in more non-maturity deposits to be able to, be able to lend that money out at some higher rates and, have some lower rates coming in for that non-maturity money. And we've seen, we've seen some improvements there on our end. We've been able to lower some of our non-maturity, or we've increased our non-maturity numbers and lowered some of our CD numbers to be able to continue to lend, so those margins will continue to kind of grow and expand.
Yeah, that's smart. Until we see rates start to lower, borrowing rates at least for financial institutions, yeah, you're going to have to think fast to be able to keep that liquidity wheel turning as things go on. I'm going to shift gears a little bit. There's another pun. Shift gears. Let's talk a little bit about. I know EFCU is prolific in your communities. In supporting your local academic institutions, specifically Louisiana State University, Southern University, both in your both in your geographic footprint. And I know you've been doing some things around financial literacy education and some other partnerships. So maybe share with the audience a little bit about the genesis of that, why that started with financial literacy with students, and kind of where you've taken it and where you think it may go from here.
Yeah, absolutely. So we had a CEO change a couple of years ago. We brought in a new CEO out of Michigan, and he actually was with the University of Michigan Credit Union. His name is Tom Kashlukas. He was the former CFO over at the University of Michigan Credit Union. Naturally, he had that relationship, already pre-established at the University of Michigan with the University of Michigan itself. So that was one of his goals coming in here, was to be able to establish some relationships with some of the local universities around here. In that time frame, since he's come in, we've signed sponsorship agreements with Louisiana State University and Southern University, multi-year agreements where we've become, some of the flagship sponsors for credit unions for those universities. With that comes, a lot of perks. We've been able to go in to both universities, LSU and Southern. We've been doing some financial literacy. I've done some car buying seminars with both Southern student athletes and LSU student athletes. People who don't really handle some of those day-to-day things. They've never really gone out and bought a vehicle. So we've done kind of mock car buying scenarios and seminars with both universities that really provide a lot of great results and a lot of great feedback from both universities, and just them just getting general understanding and general training about some real world life things like going out and buying a vehicle has been tremendous help to some of these kids and some of these students in these communities. And it's it's not information and it's not education that they typically get in the classroom or out in their day-to-day life, because typically these are generally sports athletics athletes who are usually concentrating on their sports, and they're not having a whole lot of time to be able to go out and do some of these things. So for us to be able to go in there and provide some of these financial literacy events, such as car buying, credit worthiness, and kind of understanding like a credit 101 type of class that we've been able to go in at Southern and LSU and kind of teach and kind of get a basic understanding, get a grasp, for these students to really understand, what some of these things mean, what some of these things do. When is a great time to go buy a vehicle? What should we be doing before we go buy a vehicle? Going and getting pre-approved. Understanding what your interest rate you potentially qualify for, what is the value of the vehicle that you may be trading in, things like that we're just kind of showing our these student athletes just basic little things that will go a long way in saving them so much money when they go out and do go buy that first vehicle.
Yeah, I mean, you're teaching them life skills, really, and it's beyond just the vehicle, Adam. It's also how you're going to pay for that vehicle. Have you considered insurance? Have you considered if there's a breakdown, how you're going to pay for all those things? So, like I've had more than 20 years in credit unions, and it still floors me that there's nothing in high schools or middle schools teaching financial literacy. It seems to fall on the community-based financial institutions and a grassroots level to go out and actually educate these kids on the realities of their financial life, that you're preparing them for things that those that aren't going through any sort of a program like this just may not have any sort of understanding of, or even know where to go to ask for these sorts of questions. So kudos to EFCU and yourself for that. I know that you also with these universities, EFCU is embarking in NIL, name, image, and likeness promotions. So not necessarily straight down the lending path, but certainly I think it's something that's helping to build your brand in your marketplace and maybe some brand awareness for potential car buyers, potential auto loan borrowers. So maybe talk a little bit about how NIL started as an idea with the EFCU and kind of where it's going from there.
Yeah, absolutely. I mean, it started with our prior CEO, Tyler Grodi. And at that point, NIL was so very new. Not a lot of people had a lot of understanding of NIL and what the ramifications were going to be. Contract obligations. How to write up a contract for a player at that point. And when Tom came in, Tom had already had some experience with this with the University of Michigan Credit Union. So, he's come in. We've got these sponsorship agreements lined up with these universities. And then, hey, now it's time that we help some of the student athletes out. We were able to do several sponsorship NIL agreements with two LSU baseball players, Danny Dickinson and Chase Shores. I happen to be the beneficiary of being able to select those players. I'm not sure if you see behind me. There's a bat above there, and there's a platform, not a platform, but a framed picture of LSU in national championship, say number 7. I happen to be a huge LSU baseball fan, so it kind of was a natural fit for me to be able to kind of identify some players of LSU's team and be able to reach out to them. And how that started was being able to go into some of these universities and start doing some of these financial literacy events. We started by doing a financial literacy at LSU, and that's how I met Danny Dickinson. And him and I quickly established a relationship. And then later on down the line, we were able to offer him an NIL deal where, he came in along with Chase Shores. They came in, we took some pictures, we put some up on some billboards, talking about some of our great products and services. And now they are recognizable faces around the LSU community. And it's just been the same thing for Southern. We've gone in, we've done a few sponsorship NIL agreements with some of their players, getting them kind of more involved and just getting the universities involved. And it was all literally through the financial literacy events that we started doing with some of these student athletes at these universities. And that's how these relationships developed. LSU specifically has actually a mock NIL, or not a mock NIL, an NIL app where you can request, a certain player. You can, and they have the contract already drawn up where the player will put his information, the credit union or institution will put in their information. It'll be a signed agreement. It'll have some kind of detailed information of what's required of their player, detailed information of what's required out of that institution. And we've been able to sign a few agreements that way and be able to really kind of push the NIL button into our favor and really kind of getting our name more out there as associated with these players and these student athletes. And it's been a really big success for us. We've seen a lot of success from both the credit union standpoint and the player standpoint. As they're succeeding on the field, the credit union is succeeding in the community.
Absolutely. I mean, a win-win, true win-win. The credit union gets greater brand awareness from representation by these players, and then they get a few dollars in their pocket, which not that long ago, amateur athletes, NCAA athletes, were getting paid a big fat zero for their performance on the field. And so now they're actually getting a little bit for the skill that they're and the work that they put in for amateur athletics. So that's great for EFCU. All right. So we usually end the pod with bold predictions, but I'm going to have a little bit of a twist here today, Adam, because you're a veteran of the pod. I mean, you can handle these sort of curveballs, right? Baseball pun there. So I'm going to do bold predictions with word association. So I'll give you a word and you give me a bold prediction on it. Okay. And these are free or your money back. Okay. So on all these predictions, so we won't hold you too hard to it. So bold prediction, word association, interest rates.
Bold prediction for the year, they probably stay the same, maybe even into halfway of 2026. I think interest rates are going to kind of hover around the same, regardless if the Fed decide to drop the rate or not. I think interest rates are going to kind of hold steady.
Got you. Used vehicle prices.
Used vehicle prices, I think, will start coming down a little bit as they have already that we've seen this year. With the influx of inventory, rates are still high. Inventories are very plentiful. At that point, when you have high inventory, you have low demand, what happens? Prices start going down. I think that's exactly what you're going to start seeing as you've started seeing over the past several months or so.
Got you. Tariffs.
Mixed results. I'm not sure what to think about the tariffs, and I don't think anyone else has an idea either.
I don't either. I don't even think the auto company executives know what's going to happen with tariffs.
I'll just say neutral because I'm not really sure. That's just a mixed bag there altogether.
Yeah, uncertainty. So here I'm breaking into this, but a little bit of uncertainty, and perhaps that's why you're seeing more cars on the lots. Just people are maybe not quite ready to make that jump, thinking, "Hey, things might get a little bit harder economically here. Maybe I'm okay with my car. It's not perfect, but it still runs, and maybe I'm not ready to take on a new payment or a higher payment."
Yeah, maybe so. It's just a big mixed bag there. No one, I don't think no one really has a good idea of what's really going to come out of that.
Right on. Okay, three more. Self-driving vehicles.
Will become a bigger thing as we progress in time. I think it's a small thing right now, but you've already seen like some, trucking manufacturing companies who have some of these self-driving 18 wheelers that are already doing, drives across the country right now. And I think that's only going to progress, especially in like the transportation industry. When it comes to 18 wheelers, I think that's only going to continue to progress.
AI, artificial intelligence.
Here to stay, and it's only going to continue to be a bigger factor in everything that we do in our lives, whether that be underwriting, lending, financial institutions, grocery stores. I mean, I went through a Taco Bell a couple of weeks ago with my little boy, and I was doing an order taker with an AI assistant. It wasn't a live person; it was AI.
Right? And burritos delivered to your door just like that. Last one,
Exactly.
LSU Tiger baseball.
We'll be in Omaha this year. We'll be competing for a national championship. This is as open as a baseball field as I've seen in quite some time. I think there's probably 7 to 8 teams that can win a national championship this year, but I expect LSU to be in Omaha.
So my crack researcher told me though that LSU baseball is ranked number one in the country right now. So, well, Adam, thank you once again for coming on the pod. We really appreciate you coming on and sharing your views on auto lending and things down the road for the economy and lending in general. And appreciate your time, and we'll certainly have you back sometime in the future.
Absolutely, Barry. Thank you so much for having me, and I really appreciate doing this with you. And I look forward to being able to do this with you again in the future.
Thank you.
Thank you.